Hi, this is a weekly recap for the Rhino trades, and we see that there's very little we can do now on this December trade, and the potential raising of the approach pressure line is next to nothing. Thankfully, the CCS are worth now only 25 cents, so we could still maybe go for one risk reversal, but I don't think it is needed. If we project now for maybe, let's say, close to expiration, 2 USD is still fine. So I don't think there's not much to do here. Let's not forget that there's a very strong resistance on 37.50. So now what we can do, of course, is simplify the trade, maybe reduce the number of strikes, but I will probably leave the trade as it is. It's slowly going towards break even. So if you are worried about the upside, yes, you can maybe start buying back one of these and maybe pay for it and finance it with a PCS. So this would be something like this, or maybe just drop it here and go for -1, -1 here. This is simple. I mean, now I'm not going to be fighting for $20, but that's something we can do. We don't have any capital shortage, so that should be no problem at all. So this is it for December, just waiting for expiry. January last week, I raised the upper expression line with a CCS which at about 90 cents, and now it is, well, it's actually okay because it's worth 80 cents. On this one, we have to be a little bit concerned, possibly now that we were caught by the Pfizer spike, or maybe, oh yes, so let's see for January. Oh, that looks okay actually, because we have now the trough of 3900. So we're still okay for about 100 points. If the market goes up, we'll be caught in the IV inversion, that is convexity, but we still have time. So nothing to worry too much unless the market really shoots up like crazy, and then we would have IV inversion, and this one will turn quite nasty. So that's a problem with CCS. At least we are aware of potential dangers there. So for now, it's okay. The market is, I mean, the trade is not doing great, but at least we've got time to raise the upper expression line, keep still the delta fairly flattish. As you have seen in the last few months with this very, very crazy market, I decided to go for, some would call it micromanagement, but really keeping the delta flat, not leaving anything to chance. So not a great month either, but I'm sure I can maybe get 1% or more on this trade. We still have the downside hedge that is worth absolutely nothing, so I may just leave it until I need to release capital, because this one is worth nothing. If I was to drop it here, I'd probably get absolutely nothing on this one. I may just leave it a GTC order, even comes as a debit now. It's probably worth zero. So this one, unless I really need to reduce capital, I'm going to leave it there. It will be worth zero at the end. Okay, so nothing much to do. Maybe a micromanagement again. So just a PCS, just to raise it, the break station line, and because I really have some capital used down below, I will probably do it in the form of a short put combo. So that would be something like this. But we still have a little Vega. So the chances of the T+0 sinking in the market was to drop rapidly is still fairly contained. So I would do something like this. So that's all I would do. Micromanagement, as I said in the previous video, it's a time where you need to prepare for 2 weeks of generally not much happening, low trading volumes, difficulty in adjusting. So in the next, let's say, week and a half, 2 weeks, the best is to have your position as consistent, stable, and adjustment free as possible. Now, the problem is that we were supposed to enter February, and with the market rounding up and volatility going down, it was no really good setup. I would be tempted to go again slightly out of the money to get some Vega. So maybe, and it looks like I will need to go for a wider structure, wider wings, just to have a negative delta at inception. Of course, this is a trade that is going to be slow to grow unless the market gets back into some form of correction. That could happen in January, so it is actually not a bad time to enter and let the market build a little bit of delta over the next few weeks. So this is something I would do. That being said, if the market corrects very abruptly, I think it's better to leave some capital aside. So I would probably go for a lighter entry, probably two of those, and probably around this. I will check for them. I will check where the strong supports are, but it looks like from the pre-election prices around 32, I think this is another bad area to put our short. So this is the trade that I have in mind. I thought with the low volatility, I would go closer to the money and normal sizes. But if I go for normal size, which would be probably a more typical rhino, of course, this is not the best volatility. Let's not forget that we have, again, IV that is more or less on HV. I mean, this morning the VIX is up, so maybe this is a good time to enter, but let's assume we would go for a closer to the money. I mean, let's have a look at a standard entry. I wouldn't want to start with a positive delta, even though it is still flattish. I don't really need to go for a credit at inception. So if you are bullish, yes, that's fine. Some profit potential all the way to about 3,800 and basically got no upside risk. So this is something, if you are more inclined towards being bullish, you can go for a standard entry. If you want to go for a more standard entry, but with a little bit more cover on the downside, this is something you can do. You've got quite a lot of Vega. So if you were to do this, I would recommend entering a CCS right away, something like this. I would rather go more ATM because yes, not only you get negative Vega here, but also if there's a bull surge, the market, this T+0 will sink very rapidly. So this is not the conservative type of trade I usually go for. Okay, that is it for now. Thank you for watching and bye for now.